The dot-com crash stands today among the greatest market meltdowns of all time, and yet I was completely unaware when it was happening. I mean, in fairness to me, I was just wrapping up high school, so the only market I was interested in was the one down the street that sold me Slurpees. But for those who swam in the froth and bet everything they had on internet companies with no income and no real business model, it had life-ruining consequences. Now, although the great defining crash of my generation, the Great Recession and its associated multi-year market drawdown, was undeniably brutal, I still look back at stock charts from the 2000s and marvel at the lasting damage. It wasn't just junk companies that suffered either. Before it became one of the seemingly invincible Magnificent Seven, Microsoft spent about 16 years trying to regain its dot-com high after a peak-to-trough drop of over 70%. Yes, the Nasdaq may be everyone's darling now, but had you bet on it in March of 2000, you would have been underwater until the spring of 2015. So when I hear that current market machinations are starting to look suspiciously like those of the dot-com era, my ears perk up. Now, last week I came across new research showing that the S&P 500 is now flirting with one scary number at last touch just before everything blew up in 2000, and it has one prominent analyst asking a very sobering question. Could we be on the verge of another generational stock market crash? Now, whether or not you believe we're on the precipice of a stock market disaster likely hinges on your view of artificial intelligence as either A, an overinflated and unsustainable bubble, or B, actually having the power to turbocharge the economy to heretofore unprecedented levels. Now, you can probably count Bank of America analyst Michael Hartnett in the former category, and if you fall into the latter, he has a message for you. It better be different this time. That was the header on a rather terrifying chart he shared recently that shows just how overheated the market looks right now. It looked at the historical price-to-book ratio for the S&P 500, and as you can see here, the last time it hit this mark, well, things didn't exactly end on a high note. Now, Hartnett also shared a second chart depicting the S&P 500's 12-month forward price-to-earnings ratio, which, excluding the black swan coronavirus pandemic, is approaching dot-com era numbers as well. And finally, the only other time the Shiller cyclically adjusted price-to-earnings ratio has been this high were in 2021, which was obviously the COVID Fed bubble, and 2000, which was the dot-com bubble, and, scarily enough, 1929. Now, before we get too crazy, it's important to point out a couple of key differences between then and now. Although stock valuations are face-meltingly high at the moment, there's at least some rationale for the high cost. Back in the dot-com era, buying internet stocks was like buying lottery tickets. As long as a company had a .com affixed to its name, it didn't matter if it had no revenue, profits, or credible business model. The buying was broad and it touched a lot of trash. Nowadays, we kind of see the opposite. Yes, there's concentration risk because so much market value is tied up in the Magnificent Seven, but those companies are ludicrously profitable and they're swimming in cash. And they also happen to be at the forefront of the next big thing, which is, of course, AI. So on that score, it's a bit of apples to oranges. Now, of course, there's another factor at play now that dot-com investors didn't have to contend with: a mad president who has kicked off a trade war and jacked up U.S. tariff rates to levels not seen since another one of those all-time top market meltdowns, the Great Depression. So when Hartnett wrote that it better be different this time, he was referring to the internet bubble, but the warning could well apply to that even darker era in the 1930s. Hey, let me know in the comments, folks. Do you think the market can continue upward at these valuations, or are we on the cusp of an AI bubble burst? Thanks again for watching, everyone. We'll talk to you again soon.